IBN is a network that represents family-owned and or run businesses, which are 83% of British businesses and about 65% of the economy. And actually, I tend to look at things through that prism, because unlike the multinationals, of course, those businesses actually believe in Britain and have a stake in the country. So I think quite a number of things I will say in the next few minutes will be with that in mind, quite frankly. I ought to sort of do a bit of a mea culpa, first of all, by saying that I would have supported Brexit even if somebody had told me that it would be economically detrimental for several years after we left. So I just want to be clear that when I'm talking about the economic impacts of Brexit and what we might do next, that in fact, that even economic downturn was a price worth paying for self-determination, liberty, parliamentary democracy and our own culture. But nonetheless, it is the case that during the period running up to the referendum campaign, when I was considering what I should do about the whole Brexit debate, that I was very much the view that in fact Brexit would be beneficial economically for the UK. However, taking into account the possibility that we might have a few bumps in the road once we'd left, that in fact there would be some creative disruption, but in the medium to long term, we'd be far better off. So I think it was just worth saying that, first of all, that in fact we could have had short-term disruption. Of course, what has happened in reality is that there's been very little of the hysterical predictions of disruption, both after the referendum itself and also since us leaving the transition period. There's been some disruption in relation to paperwork. Must remember, of course, that anything to do with exports to Europe represents a minority of businesses. Only 8% of UK businesses actually export to the EU, and it represents around about 13% of the economy. So actually, the benefits of Brexit should accrue to the vast majority of the economy. That is to say, businesses that export to the rest of the world, and also businesses that operate only domestically, which, if you do the maths, means 92% of businesses would benefit from government policies that can be adopted post-Brexit. But one of the things I said right at the very beginning was that our economic performance and success depends very much on the policies that the government adopt. And actually, if the government were to adopt no policies that will take advantage of our new freedoms, then clearly that wouldn't benefit the economy, and there'd be a proportion of the economy that might well be disrupted. So it's extremely important that the government, as quickly as possible, start to adopt policies that are taking advantage of the new freedoms that we have in relation to Brexit. And when the Chancellor presented his mini budget recently, the Independent Business Network made a submission to the Chancellor prior to the announcement, and also a response to the Chancellor after the announcement. I wrote one or two pieces in the press about it, because it was quite disappointing in many ways that the government haven't yet grasped the nettle. Now, they have made some progress. The Liz Truss has been doing a sterling job of rolling over the trade deals that the EU have to the UK. And of course, it's worth recalling that many of the Remain pundits said that that would be impossible and would take a very long time, and countries wouldn't want to do business with little old England. But in fact, that's complete nonsense, because the vast majority, if not all, of the trade deals that the EU have had with third countries have been rolled over completely to the UK. But what has not happened yet is that we've had no serious enhancement of those deals or new deals being created. And it's very important that those things happen in the not too distant futures. But I know that Liz Truss is working very hard to try and achieve that. But let's not forget, the vast majority of the economy is actually domestic. And it's hugely important that the UK, in my view, adopt a super growth approach to a post-Brexit Britain, particularly because the post-Brexit Britain is a post-COVID Britain. And actually, COVID has brought into sharp focus not only the need for the UK to adopt policies that will boost the economy, but also actually the advantage that we have the freedoms to do that. So it's been both a shall we say, a mirror to the UK economy as COVID, in the sense that it has actually highlighted the need to boost the economy very rapidly, but also has highlighted how important it is that we have our newfound freedoms to do that. And that basically, in a nutshell, adds up to three things. One is that the UK should be adopting a low tax approach to the economy. That the Chancellor's increase or promise to increase corporation tax was a very bad signal, and the Independent Business Network have been calling for corporation tax to be reduced with a view to eventually eliminating it, because it is a tax that British businesses pay, but foreign multinationals tend to avoid paying by finding other means of registering outside the UK for corporation tax purposes. In addition to which, of course, corporation tax itself is a tax, a relatively small tax by comparison with VAT income tax, but nonetheless one of the three big tax areas. But it is a tax on profit, and this year would have been an ideal opportunity to actually deal with corporation tax, because the chances are that profits will be depressed as a consequence of the COVID year. So tax, I'm just using corporation tax as an icon, but in fact, the IBN called for the government to continue with its tax breaks on business rates and VAT with a proper review over the period of 1 to 2 years that those tax breaks were taking place because of COVID, with a proper review as to how those taxes can be reformed, but also that corporation tax should be phased out, and that certainly there shouldn't be increases in income tax. What the Chancellor actually did effectively was tax both production and consumption, because he increased the threshold or froze the thresholds on income tax, which means there's more people paying more income tax. Now, people will say, of course, well, how are we going to fund the COVID recovery? How are we going to pay down the debt? Well, two things on that. I'm sure we'll hear a lot more from our eminent economists who know a lot more about this than I do. But the government have an option at the moment, as they did in fact post World War I, of issuing perpetual bonds at a relatively low rate, which gives them complete certainty of what rate they'll be paying in the future, to maintain their debt level as it is at the moment and to pay for boosting the economy. We know that boosting economic growth produces more tax receipts without the increase in the rate of tax, and we all know about the Laffer curve and so on. So for sure, we could at least experiment for a few years to see what actually happens if we get super growth in the economy in relation to tax receipts. And if we don't get growth of around about 3% per annum, we will have long-term relative economic decline versus the rest of the world. And is that actually what we want? I mean, we shouldn't be satisfied to have long-term economic decline and go for what some people on the Monetary Policy Committee used to call the new normal of low growth. The second thing, of course, is deregulation, which is hugely important for the domestic economy in terms of actually getting the benefits of Brexit. The Chancellor, in my view, should have started his deregulation programme by looking at himself, at the Treasury, because the UK tax code is extraordinarily complicated. Of course, people make money out of that and will tend to oppose simplification. But a simplified tax code would be a good start in terms of reducing the burden on business of regulation. But there are lots of regulations that we can actually tackle. For example, the Agency Workers Directive, we asked for that to be extended to 6 months so as to cover seasonal workers without them having to be registered as though they were permanent. Those sorts of things cost business an awful lot of money. And the government seemed to have adopted a position that we will maintain parity with EU regulations and take advantage of of divergence from new regulation in the future, when actually this should really make a serious effort to cut regulation and to simplify regulation that already exists and have divergence from EU standards now, in order to actually give us the opportunity for businesses in the domestic economy, particularly, to be more productive. And then the third area that I have a hobby horse about is access to capital, because if we're going to have a super growth economy, having a green investment bank just for green projects is not good enough. Having free ports, good as they may be, is simply not good enough. If free ports are so good, why don't we apply quite a lot of the policies that apply to them to the country as a whole, rather than simply shifting investment around the UK? Why not suck investment from around the world? So my view has simply been that in relation to access to capital, we do need the possibility of long-term patient loan capital to be available, the sort of thing that created Silicon Valley, the things that the Germans do with 39 billion a year of euros free of state aid into the German economy via the KfW banking system, that actually access to venture capital and to private equity capital is not sufficient in itself. Particularly if entrepreneurs want to keep control of their businesses and grow them to the next stage. We'll never have a Microsoft, we'll never have an Elon Musk in the UK, because we always have to sell before we get to that stage. So those are the three areas that I think are particularly important. There is an outlier, which my colleagues here will disagree with vehemently, but which John Mills and Roger Bootle often raise, and that is that we also ought to be sensible about the valuation of the currency. So allowing the currency value to grow and grow and grow as Britain becomes more and more successful is not something that we should relish. People always report it as a weak currency rather than a competitive currency. And my view is that if we're going to actually get an increase in productivity in the UK and we're going to increase exports, we have to have growth in the manufacturing sector as well as in services. And the investment in the manufacturing sector that produces more growth than growth in services. AI, of course, might change that to some degree, but nonetheless, you get a better bang for buck investing in manufacturing than in services in terms of productivity, and manufacturing will only be successful if, in fact, it can compete at a reasonable currency valuation around the world. So that's a bit of an outlier. But of the three main areas that I'm particularly interested in are tax, deregulation, and access to capital. So there we have it. That's me.
Let me now share my screen and say a few things about the outlook and what we can do in the present situation. First of all, I'd like to say that I very much enjoyed John's talk, and I agree with almost all of it. I think he brings to the discussion a terrific business perspective, which I really appreciate, and I think is spot on, really. So what I just want to do is to add a sort of typical economist angle on all this. And let me try to make this thing work properly. So I want to start off by talking a bit about Brexit policy, where we are, and John's talked a lot about that, and then a bit about the outlook after the coronavirus, and then press on to the question of the public finances and fiscal and monetary policy, which is very important, and a very important part of the new strategy. So let me start with just a quick review of points from Brexit policy, which John's talked about, and I basically, he's made all the points that I think need to be made, that we need to go ahead with this free trade policy. Liz Truss is working away, and it's really good that she is. And there's plenty to be done, though, to complete the free trade part. We've got the deal now with the EU, which is clearly still needs work from Lord Frost as we move ahead with a cooperation on a whole bunch of areas. But what Liz Truss needs to do is to get these free trade agreements, as well as the rolling over of the deals that she's done very successfully so far. And then, as John said, we need to get on with regulation of our own that suits the UK economy. And we can see from the whole experience of the vaccine episode how important that is in terms of getting behind businesses that are innovating and helping them with the permissions and so forth that have got our vaccine industry off to a flying start. Immigration, of course, is we have to get those new rules into operation. And with those departures in policy that are part of what already should be agreed to be going ahead, our models of the economy suggest that there's quite substantial gains to be made to the economy from pursuing those things that are already in train. Of course, the Remain group, talked about the losses from barriers with the EU, but fundamentally, they've used the wrong model in all this, and their gravity model has been shown by our work comparing it with the UK trade facts that it just doesn't fit. The model that fits is a kind of much more traditional model of international trade where there's competition across the world, and the EU is just one more competitor. And so that's really where an awful lot of the flack for the Brexit case has come in from these Remainer arguments, but it's all basically misconceived. And a lot of those same people argued that we wouldn't get a free trade deal with the EU because it was such an asymmetric situation that they could force us to take whatever they would they wanted to make us do. But of course, in fact, what our modeling shows is that tariffs with the EU, which would have happened if there hadn't been a deal, would cost them, not us. And of course, non-tariff barriers are basically illegal. And a lot of the sort of disruption that's going on is the result of just introducing new modes of new things at the border that really should in time settle down quite straightforwardly once everybody knows where they are. So no deal would have been bad for the EU. And so, of course, from our point of view, we wanted the deal just to be a good neighbor, really. And so a Canada plus deal was always likely. And that, of course, is what we've got. So now what needs to be done is simply to complete the other part of the story, which is the trade with the rest of the world and the regulation that John's referred to. Now, let me turn to the virus and COVID, because this is obviously very important context for the economy going forward. And what, of course, we had this second wave, which was augmented by the new variant and caused the latest lockdown. And now this wave is pretty much over, helped by not just the lockdown, but also mass vaccination. And the idea in current policy is that we'll have mass vaccination in the autumn in anticipation of fresh waves, much as we do with flu. And that should work, as far as we can tell, just as it works with flu. Of course, flu, sometimes we have bad years where you get these so-called excess deaths more than normal, up to about 40% in a bad year. But there's no reason really to believe we can't handle COVID in the future with vaccination policy like this. Some interesting things that I'll show you in a minute in the facts is that in this second wave, there's been an encouragingly falling rate of hospitalization and death. Of course, we don't fully understand why, but it could be a sign of what lies ahead, just as has happened typically with flu over the past. So looking at a few figures, just to show you briefly what's going on, here are the figures for the let me just try so that I can see my own screen. Here are the figures for people with infections who had tests, and as you can see, the second wave is moving away now, and so let me see, why am I not? And then we can look at the deaths from COVID, and you can see again those are really coming down sharply now. And this excess deaths is an important concept, and you can see this gaggle of lines here shows years in the past, and the worst in the past was this red line, which is the worst in the past is 2015, which is the sort of thick blue line that you can see in the middle. And then the red is the excess deaths we had at the beginning of this year, and the blue is the excess deaths we had from COVID in the middle of last year, or rather in the spring. And this just shows the way the COVID excess deaths compare with the ones that, which is the red and the big blue, of course, last spring. And the red is this year, the turn of the year. And the blue is a bad flu year, really. As you can see, the excess deaths this year have been rather worse than in a bad flu year. And of course, it was the end of last year, and this is the light blue line is last year. You can see at the end of last year, the excess deaths from the second wave were spiking rather alarmingly, which of course was what forced the lockdown. And then with the lockdown, the excess deaths are now coming right down, which is much more reassuring, of course. So pressing on, the evidence you see on the deaths per case is that they've come down sharply in the second wave, and also the hospitalization per case has come down very sharply from the first wave. So that's quite encouraging. Of course, we don't fully understand exactly why this has happened, but it's encouraging anyway, and we can probably extrapolate this. Now, so what sort of recovery are we getting? Well, as the virus retreats under the vaccination drive, growth is coming back more confidently. And we can see that in the quarter one, there's still a second lockdown effect, which has given us a sort of drooping V. But in the second quarter and the third quarter, the V should resume. And in the rest of the world, there's quite a V-shaped recovery led by China and the US. Of course, the EU remains weak because it's got a second wave that's still going on, and it's lagging in vaccination, which is due to the general failure of managing the vaccination process that we know about. So here's the figures for the monthly behavior of UK, and you can see that there's the drop, the first lockdown, and then the recovery subsequently as the lockdown was eased, and now the sort of second drop going on. So what does this mean for the quarterly pattern? Once you allow for the fact that the second lockdown is not being reacted to quite so badly as the first lockdown was, you get this pattern here, which is our latest forecast. And you can see the beginning, this is the quarter one drop in the second lockdown, but then second and third quarters should see quite a steep recovery as we get out of this COVID, as we've seen. And then the economy should catch up, really. And in fact, what we've got in our forecast is, I think, a pretty reasonable picture of the economy catching up to where it would have been if it had continued at trend growth from 2019. Remember, trend growth in the British economy is about 2% a year. So this pattern of what would happen if we don't do much about policy, but we get this COVID recovery and we support it in a normal sort of way that's been talked about by Rishi Sunak in his latest budget, we should get a big rebound in output and then a further sort of catching up onto where we would have been. And as I say, the trend where we would have been is roughly where we reckon we should be by the end of 2024. So we catch back to trend, we reckon, by the end of 2024, but catch up to where we were pre-COVID by the end of 2021, by the end of this year, essentially. So that, I think, is a reasonable picture. Now, the thing is that picture hasn't been embraced. Let me just quickly look at the rest of the world. So these are the JP Morgan manufacturing purchasing managers index picture, and you can see the blue line here is the purchasing managers index, and the red line here is where manufacturing year-on-year growth should be in the light of that index. And you can see that year-on-year growth in manufacturing has now resumed, and it's led by the US and China. And you can see the purchasing managers indices is indicating that quite a lot of countries now are in positive territory, which is good in spite of the second wave. And here's the GDP picture that's equivalent. And again, you can see that according to the purchasing managers index of the market, JP Morgan, growth at the world level in GDP is also becoming into the positive area of about 3%, according to the latest PMIs. And the COVID containment index is kind of getting smaller across the world. So it's an encouraging picture, really, of recovery. And so what's a bit here's our forecast that we think is likely from all this. So you can see that in the year-on-year figures, this shows up in quite a bounce back with 8.5% 2022 and then 3% following. But there's another side to all this, which is this recovery is likely to spark inflation. And we've got in our forecast quite a bounce up in inflation. We think it'll be about 5% in 2022. That's next year, essentially because commodity prices are really taking off at the moment, and worldwide excess capacity is likely to fall sharply during the recovery period with massive money supply growth around the world. And the US Fed has said that it's not going to take any action really to damp down money growth during 2022. So we think worldwide commodity inflation will be pretty serious, and that's bound to feed into our inflation and trigger inflation here, where policy will be, at the moment, we don't see any sign from the Bank of England that they're going to tighten up. But obviously they'll have to, given they've got an inflation target of 2%. And so we think that as inflation takes off during the next year or so, they will have to raise interest rates, but finally reaching about 5% by 2024. So that's how we see the prospect. Now, quick word about the key elements in this prospect. So in growth, as I say, reaching back on trend, inflation reaching 5%, then gradually being tamed, and that due very much to the worldwide commodity boom that we can't really avoid. And then interest rates rising to 5%. So a quick summary of our forecast there. And here's the figures on commodities. You see, they're absolutely taking off. This is a general commodity index in sterling terms, and it's basically doubled from about a year ago. And oil, of course, also taking off quite sharply. So where does this leave the finance forecast? Well, we think that because GDP is going to be quite a lot higher, both with prices and output, giving it a boost, that's likely to stimulate tax receipts quite substantially and bring the PSBR down as a percent of GDP to about 1% by 2024. So already we reckon with the status quo policies, the public sector borrowing requirement is going to come right down, and that will enable us to gradually get debt under control. Now, the thing is that the Office of Budget Responsibility has been much gloomier than all this, and I think unwarrantedly so. And if you look at this slide here, summarizes just how the Office of Budget Responsibility is well below our forecast. By 2024, they are some 6% below our forecast. And interestingly, they're quite a lot below the Bank of England forecast too, which is the second line here. So it isn't all officialdom that's gloomy as anything. It's just the Office of Budget Responsibility in the Treasury. And, you know, one is a little bit suspicious that the Treasury is really kind of over-egging the gloom omelette so as to persuade the Chancellor to not do the right thing in terms of tax increases. He's as John has said, instead of tax cuts and supply side reform, he's really sketched in tax increases, which I think is quite the wrong thing. So the OBR really has underpinned that. And if you look at the OBR's PSBR, it's very gloomy. But if you adjust it for the under forecasting of nominal GDP, it comes pretty much closer to our picture. In fact, it even goes into a surplus. So the OBR really have just not allowed for enough growth. And that's an important omission in terms of our main you know, public sector monitor. It's just playing the gloom game, which is very upsetting. Now, in fact, if you look at the public finances, they've been very successful in terms of dealing with COVID and have proved that, you know, if you've got an independent monetary authority and you've got a bold fiscal policy, you can deal with something like the COVID crisis. And it's done it at very low interest rates. And as John said, I think it could issue perpetuities paying interest coupon only. And it's really baffling why it hasn't. But again, I suspect there's a sort of inertia in officialdom here that is against making the right moves, because of course, if the Treasury does issue perpetuities in place of its existing debt, then the public finance outlook becomes a lot better, and that doesn't really suit the Treasury, I'm sorry to say. There are various other aspects in the public finance situation. The bank is now buying most of the debt through its QE policy, and that's probably not a good idea because the debt is still in the public sector. And really, this debt needs to be put into the private sector soon at these low interest rates that are now prevailing so that the taxpayer is protected. And then the other thing that the bank is doing, of course, is printing an awful lot of money, which is threatening inflation, as we've seen. And it really needs to get out of this mode and to start to tighten money and end the zero lower bound by raising interest rates. Now, if all that happens, what are the figures for debt? Well, under the status quo policies that I've just sketched out, in fact, the outlook for debt is not bad at all. And remember that after the Second World War, and indeed after the Napoleonic Wars, we took a very long time to bring our debt ratios down. And that's the right thing to do, really, because you really don't want a great big sort of tax-raising episode that throws the economy into confusion. You're much better off taking your time to bring these debt ratios down. But under the status quo, you can see here that debt by at the end of 2020 financial year was 76% of GDP. And by the end of 2024, it'll be up to 81% of GDP. In all this, I'm leaving out the bank's QE, which is really a big distraction, because in the end, it ought to get rid of that QE. And then on the numbers I've shown you, by the end of 2034, even on the status quo, without any tax cuts or anything like that, which I'm going to talk about in a moment, debt comes down to 50% of GDP, which is sort of rule of thumb, safe number. Below 60% is kind of the rule of thumb, longer run, where you need to be safe on solvency. And so you can see that even without any programs, a debt will come down in line. Now, so summarizing the whole deficit tax situation, the taxpayer cost of COVID of COVID in terms of debt interest is very small. It's about 1% of GDP, which could in fact be resolved by 4p on the income tax. But that would be a bad thing to do, just as it would have been a bad thing to pay for World War II debt straight after the war. They should really not raise tax until economic growth is going strongly. And as shown, that long-term solvency is perfectly assured if they don't. And so instead of these fiscal rules that the OBR keeps on throwing at us about, are you balancing the current budget now, and have you got your PSBR down to zero now, and all those sort of things, that's really quite inappropriate. They should be looking at long-run projections of where the debt is going, the debt ratio is going, because that's what solvency is really all about. And they're not doing that, which is very, very disappointing. So the last thing I want to say is that it's actually possible, even with this huge COVID debt, to safely finance an ambitious program that supports the post-Brexit, post-COVID environment with supply-side cuts and infrastructure and tax reform to get growth really firmly going at the sort of 3% growth rate that I think we need to aim at, rather than the 2% trend. And we can do that. And here's a package that I think could do it. It costs about 100 billion a year. Start off by sticking to the plans to cut corporation tax, get rid of the top rates of income tax and the additional rates, and cut the standard rate as well. And in total, that plus another 24 billion on infrastructure, which is mainly orientated to the north, would cost you about 100 billion. Now, some would throw up their hands and say, but this is totally irresponsible. But actually it isn't. I'll show you how. Because if you put these things into a model with the supply side, like the Liverpool model, which we built many years ago and have updated recently with a regional model, you get a gain to GDP from cutting taxes. And if you cut taxes by 2%, the general tax rate by 2%, you get a gain on GDP of about 1%. And that happens through the process of making the labor market more competitive. And John's talked about competitiveness. And so what you would find is that the second round effects of this fiscal round plus program would boost growth. And in fact, it would boost it with the infrastructure element as well by about 1% a year, according to the model. So what's the solvency arithmetic then of this policy package? Well, it adds about $1 trillion to debt directly through the 100 billion a year over the next decade. And that on its own would take the debt ratio back up again. But with the growth rate higher by 1%, the tax take each year, which in the base round is about 38% of GDP, it rises cumulatively by 1.3% a year. And that's about 0.5% of GDP. And so that pays off debt directly with higher tax revenues by 25% of GDP. And that gives you a debt ratio in 2034, 10 years on, of 50%, which is just about the same as the pre-package. So what you can see from all this, and that's my last point really, is that a bold supply side package is sustainable in terms of solvency and actually pays for itself. And so let me rapidly conclude. We've got here prospects for a fast post-COVID recovery. And what we need is bold policies that have already been sketched out for Brexit, free trade, better regulation. And those need to be accompanied by a bold supply side fiscal policy with supply side reforms and tax cuts supported by fiscal policy on the demand side. Inflation needs to be restrained by monetary policy, which is something the bank really needs to do and should do if it sticks to its policies of a 2% inflation target. And in this fiscal package can be afforded through the tax proceeds of growth. So thank you very much. That's the end of my remarks. Thank you.
Thank you, John, for your presentation. I love that phrase, creative disruption. I'll use that myself. And Patrick, I agree with some of the things you said, so which makes a change, perhaps. Now, I've got a presentation. I'm going to try and limit this to 10 minutes. We've got the topic is Britain at the Crossroads, which is a pretty general topic, and I'm not quite sure what I'm supposed to say. I'm going to just a couple of minutes about Britain in the 21st century, and then I'll focus on about 3 specific issues just relevant at the moment. As far as I'm concerned, Britain is still an important nation, but obviously we're not a great power. Not like the end of the 19th century when the British Empire accounted for about over 20% of world output, and Britain itself over half of that. We're not like that anymore. And we have to adjust our ambitions to where we stand, but we can be, I think, more closely associated with Canada and Australia. We can be friends with America and the EU. And I hope we then have a weight in world affairs that is out of all proportion to our very much diminished economic weight. Maintain our position as a champion of global free trade, an open world economy, supportive of liberal democratic ideals, and so on. And I don't see any reason why we shouldn't remain an important nation all through the 21st century, although, of course, not like we were in the past. So that, I think, is the first thing to say. And it's quite important just to get these things clear, that we're not going to be, Brexit doesn't mean that we're going to become an isolationist, inward looking, and so on. And that's very important to get that up front as a crucial part of where Britain stands in the 21st century. Now, there are 3 very specific things I want to say before I finish. One is about inflation. And is this coming up in front of everyone? Can everyone see this picture of money supply growth in the UK? Can we see that?
Yeah, we've got it. You've
got it, have you? Very good. Yeah. The rate of growth of money in the UK at the moment on an annual basis is 15%. This figure is the highest since the late 1980s, highest therefore for 30 years. Patrick will remember my warnings at the time about how rapid money growth would lead to inflation and a boom and a bust cycle. And it jolly well did, I'm afraid, Patrick. And I'm afraid that something similar is going to happen this time. Of course, we don't really know the details of all this. I would say the intellectual climate is very different now. There isn't the same interest in monetary data. We don't have a government that's interested in monetary analysis at all. And the Bank of England similarly seems to have forgotten about the basics of monetary economics, in my view. I think we should be expecting certainly 5% inflation. I agree with Patrick about that. In the United States, they're even more, they're throwing caution to the wind. It was understandable that governments and central banks should do this, given the challenge that they faced last spring. All the same, they have behaved, in my view, in an irresponsible way. And the post-COVID adjustment problem will be 2022 and 2023 rather more difficult than I think Patrick imagines, but we'll see. That's the first thing I want to say. And there's nothing distinctive about what's going on in Britain. These rapid money growth patterns are found in all the main countries. Japan, not so much, by the way. China is not doing this at all. So very different kind of patterns around the world, but the main countries have all got rapid money growth. There is inflation coming up. Now, our neighbors. Look, I'm a Brexiteer. I was in UKIP. We want to have a European continent next to us that is stable, prosperous, and successful. And we want to be friends with them. And so let's just get that out straight away, that we might want to be friends with them. And I hope that they succeed in having vibrant, dynamic economies and so on. I'm sorry, that's not what's going on at the moment. I'm going to focus on just two things. The first thing is this vaccine fiasco really tells you what's wrong with the European Union. Basically, all members of the European Union have got two governments. All these nations have got two governments. They've got one in Brussels, one in the national capitals. These governments are, in fact, these governments are in conflict. There are also tensions between them and various European institutions and agencies that have been set up. It's a mess. And this kind of problem of tensions between different governmental authorities is inherent in the European construction. This is one of the key reasons why I wanted Britain out of the EU. And my word, has the first year, full year outside the EU demonstrated just how important that was. We are going to get the COVID virus under control probably 6-9 months before our neighbors. Now, my expectation is going to cause quite a lot of anger. And so we're seeing some of that at the moment in the way that some European nations want to bully the AstraZeneca and so on. But this is a very clear illustration of the problems that the EU is creating for the members of the EU. But I also want to talk about the single currency. Obviously, we've been talking about single currency, the Bruges Group, for 30 or so years. And you might say that, well, it's still there, Tim, and, you know, haven't you been wrong about this? Well, right and wrong, I would say. And can we get does that picture come up all right, Barry? Is that, you've got the picture of the debits and credits in the Target 2 system? Basically, you'd expect, banking systems are about making sure that sums add up at the end of the day and you cancel everything out. Debits and credits are all cancelled. Sorry, that's not the way the single currency works. The way the single currency works is this thing called a Target 2 system. And it's possible for some central banks to have debits lasting years, be in debt to other central banks for years, others in credit other central banks for years. What's happened in the Eurozone is that everything's more or less tickety-boo until the Great Recession. And then, as you might expect, the Germans became the very big creditors. So at the moment, the Bundesbank has a credit position in this Target 2 system of over 1,000 billion euros. That's about half of Germany's net external assets. Germany's had all these current account surpluses for years. They're left with this asset so-called, being worth half of that. And then there are the debtors. And again, you might be surprised, they're Club Med. They're basically Italy and Spain, Greece, Portugal, and so on. But the Italy and Spain have both central banks owe 500 billion euros to this system. Now, what that actually says is the Germans have provided the rest of Europe with about 1,000 billion euros worth of goods and services on which they haven't been paid anything. And the way this system works at the moment, they are receiving no interest payments. They have this huge asset that doesn't give a proper return. Now, that's bad enough. And the Germans don't like that and they're complaining. But then what's also happening is that you have, in the last 6 months or so, you've had the European Central Bank itself. Germany is outnumbered. It only has it's one country, one vote in the European ECB Governing Council. The Italians, the Portuguese, the Greeks, they have together more votes than Germany and one or two other countries that are more tonic, if you wish, more careful about their finances. And so you've got Mrs. Lagarde. I had to have some pin-up in my presentation. Mrs. Lagarde saying that they know that they've got this problem emerging, and that to some extent bond yields are rising because of lack of confidence. What are they going to do? The ECB is going to buy more government bonds. the government bonds of Spain, Italy, Greece, and so on. Two consequences. One is these nations have suffered no bad consequences from running into debt. And two, the effect of these purchases of bonds is to increase the money supply. So what you've got in the Eurozone, money growth isn't quite as high as in the UK or in the United States. It's up about 12% in the last year. I doubt very much that there is much trend economic growth in the Eurozone at the moment. Again, inflation is going to follow. So it's going to be, in that, will make the Germans very angry. So we've got a number of very worrying trends in our neighbors. I'm a Brexiteer. I want to live in a safe, stable, prosperous continent. I'm sorry, our neighbors are making a dreadful mess of it. Thank you.
I couldn't hear the question. Maybe Tim could repeat it, because
basically the question, Patrick, is in the 1780s, inflation was very obstinate, very persistent. This time, everything's come down and controlled very quickly. Why?
Ah, yes. Oh, that's a very good question. Well, I think because we've had decades now of very weak inflation, and so I think expectations will be quite slow to respond, and therefore what happened, of course, in the 70s and the 80s is inflation took off and expectations took off as well, because it was kind of it was felt rightly there was no control of inflation at all. But now we've got an environment in which the central bank is committed to bringing inflation down to 2%. So I think it's a very different environment. And even I completely agree with Tim's remarks about the money supply. And these are astonishing growth rates that we're seeing in the US and the UK. And indeed, they're not far behind in the EU. But the whole environment is quite different from an expectational point of view. And you can see in gilts markets that expectations have risen a little bit in terms of expected future interest rates and so forth, but not very much. So I think the environment's just very different from the point of view of policy. In the 70s, there was no commitment by central banks to do anything to restrain inflation, really. It was all down to the politicians. And in fact, the central banks, look at like the Bank of England, were all gung-ho for financing it, actually. And it was politicians like Thatcher and Reagan that kind of were tough on inflation. Today, the central banks have all been given independence, and they've all got these inflation targets. So I think if they do stick to these policies, it will be possible to bring inflation down, and without triggering this huge upsurge in inflationary expectations that we had in those dreadful days back in the 70s. So a long answer, sorry, but that's the way I see it.
Thank you very much, Patrick. Tim, do you agree with that analysis?
I think it's very important what people expect inflation to be, because if people expect rapid inflation, it's more difficult in terms of the costs of unemployment and so on to get inflation down. Having said that, the necessary condition for reducing inflation is a reduction in the rate of growth of the quantity of money. And I'm sorry, my subject, economics, is a fantastic mess about this subject, as it has been for a long time, but that is the key condition. Barry, I don't know. I just simply don't know what the rate of money growth is going to be, say 2 years from now, in any of the USA, the UK, and the Eurozone. It's as bad as that. It's a sorry comment on central banks and economics that this is the situation we're in. I honestly don't know. My expectation is, in fact, I suppose I had to summarize, I've got to give some sort of view, is that inflation will come down. But part it'll be because the banks, as ever, since the Great Recession, will be kicked around and they'll be stopped from lending to the private sector and helping the private sector to grow, because the banking systems will be required to lend to governments.
Okay, thank you very much for that. Any comment? Do you wish to comment on that at all, John Longworth?
I think the only thing I would say is that, listening to what Patrick said, what Tim said, my concern, I guess, is that there's an enormous capacity for the Chancellor and the Treasury in the UK and for the ECB and the European policymakers to muck up what actually could be quite a benign projection for the future. You know, if you look at the figures that Patrick put up about the status quo endpoint in 2030s, or how much better it could be if they adopt the right policies for the economy and economic growth, they could also adopt the wrong policies and actually make a complete mess of it. And we are at a crucial moment, because if the Treasury don't get a grip of what the opportunities are and actually start to adopt poor policies, all of this potential light at the end of the tunnel could end up simply being snuffed out.
Thank you very much indeed. Could I just ask the listeners, we've got a big audience for this, and it's your opportunity to send in questions. Please do send in questions. I'd just like to follow up on a point that you made, John, in your remarks, where you said you would like to see the currency being more competitive. What policy would need to be implemented to achieve that competitiveness?
Well, it's very tricky. I mean, Patrick, I don't want to put words in your mouth, Patrick, but you would say that's quite impossible and probably wrong-headed anyway. But to actually try and do that, but there are a variety of levers that governments can adopt in order to try and dampen down currency valuation growth, if not, in fact, reduce value of currency. Simply around things like sentiment, interest rates, purchasing of foreign currency, and so on and so forth. I think the thing is a little bit like this question about access to finance, access to loan capital. We seem to have a doctrinaire approach in the UK because we're a free market orientated economy, that these things are wrong. And yet every country in the world, including the United States, practice these things. They have, in terms of access to currency, they have state-backed funds, both federal and state level. And they've been extremely important from the point of view of development of sectors of the economy and actually growing to the next stage. Similarly with currency, most of the economies in the world, through a variety of means, try to maintain a competitive currency. We're a bit naive, I think, about this.
Can I say something about that?
Please do. Please do come back, Patrick.
You know, I've had this argument with John quite frequently, have we not? And I take his point, but the thing is, I don't think you achieve competitiveness by devaluing your currency. I think that's the key point. You achieve competitiveness by having low taxes and good regulation.
Yeah, I agree with that.
And I think we agree about that. So what does this currency bit come to? It really is a way of kind of saying, well, monetary policy shouldn't target inflation and money, but it should target the exchange rate. And of course, that's not a great idea, I don't think.
No, I agree with that too.
Because the thing is, there's a conflict between these two objectives. I mean, if you want to bring your currency down, you can do it by pretty irresponsible monetary policy. It's kind of well-known playbook. And the problem about that sort of policy is it feeds inflation. And that's the biggest worry, I think. So I would say the right thing for policy to do is for the central bank to keep monetary policy under control. And I very much agree with Tim that in practice, this means controlling the money supply. And of course, people say, oh, well, it hasn't mattered, all this QE, because in the financial crisis, the banks, the central banks printed all this money, but it had no effect. And of course, that's true. But the reason it had no effect was because they brought in draconian regulation of the banks, pretty much as Tim is saying they might do again, in order to stop money growth happening. And so what they did was they crowded out private sector credit and gave it all to the government, which is not healthy at all. And so I think that monetary policy really needs to focus on inflation and the control of inflation through through the control of money and credit, and not go back to this sort of regulative situation where they repress private credit, and certainly not really kind of try to throw money into the economy to bring the exchange rate down. I think that'll just create inflation, John, and you wouldn't like that very much at all, I don't think.
Well, that's it is an outlier, the currency thing, but I also don't think we should let it run riot, because there is a propensity, I think, in the UK economy, particularly in the city, to be desirous of a strong currency. What does that actually mean, and what's the purpose? And so, I think growth is one of the targets that the central bank should have. Actually, in my view, economic growth should be.
This is the kind of thing we heard in the 1970s, and it is very. John, I want us to be friends, but it's absolutely clear that in the 1970s, 1980s, we had all these debates. Monetary policy should keep inflation down. Supply side policy is about light regulation, low taxes. Don't try and lower interest rates, get the exchange down to boost growth. That's what they do in Venezuela and Argentina. Sorry, it doesn't work. Switzerland and Germany, on the other hand, they couldn't care tuppence about high exchange rate because they had good underlying productivity in their economies.
But Switzerland actually managed its currency for a very long time, not successfully in the end. But I mean, it's wrong to say they didn't try. Germany's managed its currency by joining the euro. All these countries do it. But let's not focus on currency as the key thing. As I said, it was an outlier. The key things are low tax, low regulation, and access to capital, particularly in addition to normal capital. Long-term patient loan capital, which is absent from the UK economy. When I say that the bank should target growth, I'm saying it should target growth using those levers, not the currency. But we shouldn't let currency run riot.
Well, I agree that it's important that we have an efficient, low-cost banking system, and I think that what happened in the Great Recession with the Basel III rules and so on has been a disaster for people and companies in Britain that want to borrow from the banks. Can I just finish on that front by saying the banks can't simultaneously have low money growth, required to lend on a large scale to the private sector, and also finance large budget deficits. Those things cannot happen. If there's a large budget deficit that has to be financed from the banks, that's going to itself cause rapid money growth. Private sector has to be squeezed out. I'm in favor of strong public finances, free banking system, low money growth. As far as possible, we want those things. We shouldn't be trying to meddle with exchange rates and interest rates to boost the supply side of the economy.
Tim, I think you were saying there you believe in strong budgetary control. Do you think the government has got that at the moment? No,
I mean, it's pretty clear that Boris, for all of his virtues, such as they are, for all of his virtues, and he undoubtedly does. We must thank him for Brexit. It was very much his personal contribution, I think, that made it happen at the end. But he's a spendthrift, quite frankly. I mean, and we see this with HS2, we see it with the increased defense budget. I mean, it may be that it's justified in some way, but let's be clear, what's happening is that public spending is rising at more than 2% a year. I don't agree with Patrick, our trend growth rate is 2%, it's more like 1%, if that. And so we are facing a prospect into the medium term of rising taxes. This is because public spending is rising faster than national output. You must, in my view, always exercise, you must be as cautious as possible about the underlying growth rate of the economy. That's not what's going on.
All right.
Well, just let me say, I mean, I think that there's been this long argument about productivity growth, but if you look at the trend growth of the GDP, it's definitely 2%. I mean, it's 2% for the last 30 years.
No.
It has been. Just look at the figures.
1.6% last decade, and of that, over 1% is because of increased employment because of immigration, Patrick. Productivity growth has been 0.5%, that's all.
It's great to have this disagreement.
If you look at the growth rate from 2009 to 2020, 2019, it's 2%, spot on. I mean, what people often forget.
You've got the recovery from the 2009 trough.
No, I'm talking about the whole trend over 30 years. It's 2%, and it hasn't actually wavered. If you
I'm
go through
talking
the
about
whole
the last
period,
decade. Last
what you
decade,
have
productivity growth is 0.5% a year. Growth has been 1.5%, and that has been reflected in immigration, increased labour force growth. The increased employment is heavily of foreign-born workers. They are leaving. Our trend growth rate is not 2% a year.
Thank you very much indeed.
Okay.
As I say, it's great to have these differences between economists that other people would think are on exactly the same page. But it's good to bring out these differences and to think further about them. Just on the issue of levelling up, which has become one of the themes of this government, do the panel members think this is a worthwhile exercise that is going to produce economic benefits as well as supposedly political benefits? John Longworth, would you like to start off by commenting on this?
Well, I mean, certainly most of the organisations I've been involved in, from a business point of view, have been in favour of a balancing of the economy towards the regions. That's not to detriment, of course, the southeast, the London and the city, because they are the generators of wealth. But we should remember that financial services is smaller than manufacturing still in the UK. I mean, it seems to come as a surprise to a lot of bankers that that's the case. The fact of the matter is that if we can actually improve exports, and the Department of Trade have had an obsession with foreign direct investment, some of which is very good and some of which is not very good, for balance of payments for sure, at the expense of promoting exports, because promoting exports is a hard job. It's hard yards. Any fool can sell the family silver below cost, but actually promoting exports requires some effort. And, that's one of my criticisms of Department of Trade in the past. But if you can actually promote exports, that in itself will create a rebalancing in the economy, because quite a lot of that exporting will be of goods, and goods are manufactured around the country. No longer in the centre of Birmingham, they're dispersed around the country. So my view is simply, if you want to level up, and from a national political point of view, it's got to be a good thing in the end. If you're not going to get complete divergence within the UK and all the issues that flow from that, you've got to actually promote exports and you've got to promote manufacturing, because that's the thing that will actually create the levelling up.
Okay, thank you very much for those comments. Have either of our other two panelists want to comment at all on this issue of levelling up?
Well, I don't mind saying something about levelling up. I think levelling up is perfectly feasible, and it's a result actually of the same supply side policies that I was talking about, because it turns out, according to our regional modeling, that the main beneficiary of supply side policies today will be the north, largely because the south is quite congested and the supply elasticities are lower. According to our modeling, the response of the south these days is likely to be lower than the response of the north. And so I think that the sort of policies that I was talking about, which are general supply side policies, will mainly have their effect through raising northern competitiveness and will act as a leveling up process. Because I don't think it's about exports of manufacturing. I think the north is pretty big on services these days, John,
No, I agree.
Even in North Yorkshire, where you are, there's a lot of service activity. And so I'm kind of with you, but I don't think it's got anything to do with the exchange rate or manufacturing. It's just about competitiveness of industries generally across the north. And so I think, if you go back to the debate about the UK at the end of the 70s and the beginning of the 80s, it was always said, that, oh gosh, it's impossible to get productivity growth higher in the UK, because of the British disease and so forth. But it turned out to be quite possible, and it happened. And productivity growth took off quite rapidly as a result of the supply side changes of that era. And I think the same would happen today, but it would mainly focus in the north because that's where the capacity is.
I don't disagree with you. Of course, we're not just talking about the north in terms of.
When I mean the north, I mean everywhere but London and the southeast.
Exactly. So
including Wales, by the way, which is very west, very south.
Exactly. So, I mean, I don't disagree with what you're saying at all, but the only reason I mention manufacturing and exports is that exporters tend to be more efficient and more productive because they have to compete in a global market. And manufacturing, you get a better bang for buck in terms of improving productivity, as I said in my presentation, except of course for the future where artificial intelligence may produce similar results in the services, but then it could also produce unemployment as well.
But the city's highly productive.
Sorry.
The city's highly productive. I don't think I'd make this city.
Right. We had all of the, John, I like to be friends. We had all this sort of stuff in the 60s and 70s. We had Lord Caldor, selective employment tax, a stupid thing to do to try and promote manufacturing. Let's get this absolutely clear. What's happened in Britain in the last 30 years, well, more like 50 years really, is that we have excelled. I'm sorry, it's in services. Manufacturing hasn't grown very much in that period. There's been rapid growth in international business services, which are now about 10% of GDP. It's not just financial services. That's where Britain's comparative advantage lies. And Caldor didn't understand this. Can I just make a point about all this? You say there's no productivity growth. You try and argue with your accountant and your lawyer about the bill they send you. You can't. The point about the accountants and the lawyers is they charge up. And Britain charges up, those business services charge up. They have low productivity growth. How do you measure the productivity of a lawyer? But that's exactly where Britain has been doing well in the last 40, 50 years.
Well, that is true.
I'm not against manufacturing at all, not at all. But let's just get a level playing field and let them all see how they get on.
Yes,
the fact of the matter is that we should not be competing with China and so on in low cost, basic manufacturing. No, thank you.
But the thing is, with manufacturing, it's very easy to damn manufacturing as if it were not important anymore and cannot grow in the UK. And yet there are other economies around the world where that is simply not true. Singapore, Switzerland, Germany.
Level playing fields.
But the thing is,
manufacturing. It's great.
Good.
I love seeing it again. Big factories. That's fine.
So
just don't say that somehow that manufacturing is magic. It isn't.
Well, I didn't say it was. I said that you get a better bang for buck in terms of investment.
That's not true.
If you look at services, productivity in services hasn't really grown over the last X.
But they put their prices up.
What has happened is you've just had more people employed at the same level of productivity. They're very good at what they do.
You go to the middle of London and you'll see wealth arising from service industries.
Yes, because those individuals are able to charge a lot of money. Now, the fact of the matter is, of course, that AI may well take that away. The fact is that you may have competitive
market
forces. But you know, John, I mean, when you charge a lot of money for a service, that measures as productivity. Don't make any mistake. As Tim just said, they charge up, and that comes into the national accounts as productivity. You know, they're getting a lot of resources paid to them for what they do. And so it is actually a high productivity sector.
I don't disagree with anything you say. All I'm making is the point that, I mean, if you want to be poetic about it, I mean, we are a nation of actors. And the fact of the matter is, the city presents these things in a very good way and therefore is able to charge more, not necessarily for better input, but they certainly present themselves very well. What bothers me about it is that it can be sometimes at the detriment of the rest of the economy, because the city makes an awful lot of money off selling assets, and you can't run a 7% balance of payments deficit forever.
Could I just make a very nice point that you made, that Britain's a nation of actors? In fact, I think you'll find that film production in Britain is booming at the moment. That is the service sector, and it's with a world market, large numbers of English-speaking people around the world. Their numbers are growing all the time, and I suggest to you that as a service industry that will flourish and prosper in the 21st century, and just leave markets sort these things out.
Long may it continue, as long as we can continue fooling people accordingly.
Okay, well, that was a really interesting discussion. I've never really thought of us as being a nation of actors before, but there's certainly a lot of them in the Tory party. The next issue I'd like to put to our panel is financial services. Now, there's a lot of concern that we didn't get any sort of agreement when we left about financial services. And now if you open the FT any day of the week, you find a lot of articles about the problems that financial services have now got. You read about Amsterdam taking over from the City of London in listings and all sorts of these things. Does the panel feel that our financial service industry has come out badly because of this? And what do they see as the prospects for financial services now?
Well, let me say, well, I don't mind which order. I might as well start off. I mean, from a trade point of view, the point is we have a comparative advantage in services, and the city is a good example of one where we have a very high comparative advantage. And what the city does is sell services competitively around the whole world. And what we know from trade theory is that fundamentally, if one bit of the world decides to sort of stop buying city services, they'll sell them somewhere else, to put it crudely, because there's a world market for services, and Britain is quite a small country, and even, the city is quite a small place. It can sell its services to other markets, and of course it does already sell them all around the world. So this idea that what the EU does is of any consequence of the City of London is absolute nonsense. Fundamentally, the EU is just one market where the city sells its services, and there are plenty of others, and it's a highly efficient and competitive supplier of services which are in demand around the world.
Could I just say on this front that we get this resentment in Europe. There's a lot of clearing in London in euros. It's not our currency. They feel that they're somehow entitled to have this sort of business within the European Union. Look, there's a lot of clearing in euros in New York and Hong Kong. There's more euros cleared in New York than in Frankfurt. I do wish that some of the top EU policymakers would just wake up the kind of world that we live in. You can have all of these trades registered in Amsterdam. That doesn't mean that's where the decision was taken or where the payments for the brokerage goes. Can I just say about Amsterdam, it's a rather difficult place in terms of skyscrapers, getting people there in terms of millions of people, not like London, skyscrapers and a huge catchment area. There's no way that Amsterdam can compete with London in terms of the international financial services. And can I also just say, it's not just financial services, there's related services, legal, accountancy, a range of consulting activities that are done from London predominantly, not just London, there's all Edinburgh and so on, a lot of these activities, other places too in Britain. And so, I think we do of course actually have some numbers on the UK's exports of financial services since 2016, when there was supposed to be, after the referendum result, a collapse in these things. There hasn't been a collapse. And so I think that free of EU regulation, Britain will flourish in the international business service sector.
Thank you very much indeed, Tim. John, have you any comment on this particular issue?
Well, I agree with what's been said. There's no question that the UK has comparative advantage in services, professional services and financial services. It sells around the world. The fact that the EU, there's a danger in equivalence rather than deregulation. If you want to put it in those terms, that actually we could be sucked in to being anchored to EU control, and actually we're better off deregulating. That's the one thing I would add to the services debate. And the fact of the matter is that the UK, excels in these areas and charges a lot of money. We've already agreed that, and therefore it's a very good profit maker. Well, the one thing we shouldn't do, however, is confuse the fact that this industry that we have, which is supreme and superior, has anything to do with the rest of the economy. And the rest of the economy also needs to be serviced by access to finance, and it's very important that it is, because you can't simply say the whole of the UK economy is the 5% that's banking, the 5% that's financial services, the 5% that's professional services attached to that, and the rest of the economy can simply go hang.
Thank you very much indeed. I've got a question here sent in from Michael. He says the problem with successful UK business is they get bought by foreign companies, ! Manufacturing has suffered from cheap labour abroad. These are difficult to correct without accepting there has to be both investment and encouragement to purchase British-made goods. I think this also ties in with companies that are developed in this country, such as Arm Holdings, for instance, being taken over by overseas buyers. Do you think that manufacturing has to be treated more fairly, or should it just all be a global free-for-all?
Well, I think this is a very difficult area. I'm essentially in favor of free flow of capital, and therefore we shouldn't be restricting foreign purchases of our companies. Of course, that does then mean that, for example, we might lose headquarters. Well, actually, London remains a favored location of headquarters, not just of British-owned businesses, but of American businesses and so on. These are just very difficult. But if we have a problem, think about Hong Kong and Singapore. They're very small and they don't stop foreign involvement in their economies. We're becoming smaller and smaller relative to the rest of the world. I think we have to accept that there is going to be increased foreign ownership of businesses in this country over time. And I just, before I finish on that, say that let's just also remember that we have British multinationals that have got operations all around the world. And it's quite important for our interest that these companies be treated fairly. It's one of the most important things, by the way, that our international relations have got to do. We need to be obviously tied up with Americans and others to make sure that these things are done fairly and properly. We've got problems with India repeatedly in the last few years, by the way, in British companies. Vodafone, Rio Tinto, BP, Shell, these are all international businesses where more operations are outside the UK than in the UK, and we can't afford to be too isolationist on this front, I'm afraid.
Okay, thanks for that, Tim. Do either of our other panelists wish to comment on this particular issue?
Well, I think it's just a case of, in free capital markets, you don't really know who owns any of these companies anyway. So if you look at British pension holders, they own companies all around the world through the FTSE. So I think it's kind of a non-issue, really. As far as small companies being bought by large companies when they are successful innovators, I don't see that our government's got any role in stopping some enterprising innovator from retiring and selling the company. I mean, one of the big incentives of innovation in the UK is that you still can be successful innovator and make a lot of money and then sell it on the open market to whoever will buy it. I'm not really bothered by who buys it. The main thing that bothers me about large companies buying all these small companies is that the monopoly power that they acquire by buying competitors, and that's a problem not for regulation. It's of the government, by the government. It's a problem for the Monopolies Commission, frankly, which I think here and in the US have been quite indolent for quite a few years in terms of allowing companies like Facebook and so forth to buy up threats to their monopoly power. And that, I think, is now increasingly being a focus of the monopoly regulation community, and rightly so, because I think they've been quite complacent about this. That's the big issue, it seems to me, for policy, that the big monopolists buy up the competition. And that's something that's very dangerous, I think, long term.
Thank you.
From my point of view, I think three things. It's a complex area, so it always makes makes the discussion of these things quite difficult. There are three things. One is that while people should be free to sell their businesses if they wish to, they should also be free not to sell their businesses if they do not wish to. And part of the issue about access to capital and access to patient loan capital, which is available in most of our competitor countries, free of state aid, is that in the UK, there is no alternative often to losing control if you're an entrepreneur before going to the next stage, because the only source of capital you can get is venture capital or private equity. And that's not right. That's the first thing, because that's the route by which the UK loses its intellectual property to multinational corporations, often foreign owned. The second thing is that the UK has in fact just introduced legislation and a new regulator for strategic industries into security. So there are now new powers coming forward to prevent the sale of businesses that might affect UK security. And the actual definition of it is quite wide. So it's not just people who make guns, for example, but it might be security in a variety of ways. And the third thing is that, as Patrick's saying, the Competition and Markets Authority does need to look hard at, as an independent nation, about the way in which we might have strategic industries taken away. I mean, what would have happened if our major pharmaceutical manufacturer had been purchased 2 years ago, which the government seemed to think was perfectly okay? The fact of the matter is that if you lose some strategic industries, you can never replace them because they will never regrow. They'll never regrow from a startup to become AstraZeneca, for example. So those are the three areas I would have concern about. And I think it's perfectly legitimate for a community of an independent nation to have concern about those things. But in general, we should have free and open economy with the recycling of capital.
Thank you very much, John. I've got another question here by somebody who's concerned about our relationship with the United States. They say that Britain has usually done well when there's been a close relationship with the United States, famously with Thatcher and Reagan. Under Theresa May, there didn't seem to be much of an effort to do a trade deal with America before Donald Trump left office. Now we have President Biden, who seems to be rather obsessed with his Irish roots. There being about 50 million Irish American voters. Have we missed an opportunity with Trump? And can the panel see a close relationship with Biden, which is going to lead to mutual economic gains in the English-speaking, the United States and the United Kingdom? Tim.
Yes, I mean, in fact, there was a sort of interim deal done by Liz Truss with the American administration on some of the current very contentious issues. It's not clear to me that in practice, the Biden administration will be more awkward than the Trump administration. I think what Liz Truss has said was that the Trump administration, talked the talk, but when it came to actually getting on with it, they were rather difficult and rather nationalistic and rather inward-looking. I'm not sure that Joe Biden in practice will be all that different. Can I just say it is disappointing that at the moment, the United States, the protectionist talk is prevalent in both the Democratic and the Republican parties.
Yeah. John, any thoughts on this particular aspect?
Well, I mean, it remains to be seen, doesn't it, how things pan out with the US, both in terms of our relationships and the Biden administration. It is what it is. It's not the best, let's put it that way. I mean, I did write an article recently saying we have very few friends in the world, For sure, Kanzuk are probably reasonably reliable friends. Beyond that, we have a Commonwealth relationship that could provide us with trading potential, and the Asia Pacific region. But I don't think we can always rely on the United States. I mean, the United States did a very good job on us after World War II at Bretton Woods, effectively adopting our world system and providing us with a debt that took us 50 years to pay off, while they wrote off Germany's debt entirely and provided them with finance as the leaders of Europe. So, we shouldn't be starry-eyed about the United States under any circumstances.
Thank you very much for those comments. Patrick, have you any thoughts from your international perspective on this?
Well, I think that there's an evolving situation here. It's not just the US, there's also the Trans-Pacific Agreement, which we're interested in joining, and the US may well join. So a lot of these things are in development, and I kind of agree with what's been said, that it's premature really to say where this will go. One thing I'm clear about is the US has quite a strong interest in having access to our consumers in the UK, and we've got a strong interest in letting them have access, because the US is a big source of good, efficient manufacturing and also good, efficient food. And, it's in both countries' interests actually to have free trade in these areas. And of course, on the services market, we've got also a strong interest in our export of services industry in having access to the US, which is almost like a home market for a lot of our services and city and so forth. So I think actually a lot of this is going to evolve over the next few years as the Pacific situation and the interests of the US and the UK, are more and more understood. And I don't think Biden is particularly hostile or going to stand in the way. And in fact, his Irish connections are quite helpful in some ways, because he knows that the Northern Ireland peace agreement is very important, and he's likely to kind of see any help he can give on that as being a good thing. So by developing trade relationships with the UK, he kind of helps generally in our relationships over trade, and that I think will be helpful also. I think he may also help in terms of our relationships with the EU over Northern Ireland, which is obviously quite a sore point at the moment.
Okay, well, Patrick, I think that's a really good positive note on which to end this discussion. I'd like to thank the panelists for the time and effort they put into thinking about their presentation, and also the depth of interest that they've shown in the answers that they've given. We've also had a bit of controversy between our speakers today, which I think has been very healthy indeed, and has enabled all of us to have a better understanding of what can often seem to be complex issues. Gentlemen, thank you so much for coming today, and I thank all of the many hundreds of people that have listened to this webcast. Thank you.
Thank you.
Thank you.
Thank you. Thank you.